What's up, everybody? So I'm going to show you different techniques for dividend mining. I don't know if you guys know, but in my previous career, I worked on Wall Street for 13 years. Then I started my own business. But I'm going to show you some of the techniques I learned. And it's mostly common sense. Once I show it to you, it'll make a lot of sense. But if you're a dividend investor, there are a lot of investors, especially people over 50, who like to stick with dividend stocks. And it makes sense to a certain degree, because if a stock does not pay a dividend, like Berkshire Hathaway doesn't pay a dividend, you feel you never get a return, because unless you sell the stock. But people like to get that consistent guaranteed return, especially in the US. Hey, the Quags. I'm trying to do more live streams. Not only I think it's good for the channel, but it helps me out to talk about this stuff. So it doesn't. When you invest in a stock, there's pretty much two ways you can get money. I mean, there's actually more than two ways, but let's just two obvious ways. It's a dividend, so you're given money. Sometimes you're given dividend stocks, but that's rare. It's usually cash. So you receive an actual cash inflow, and you have to take it. You can't not take it. You could, however, set up your account where all your dividends automatically buy stock in that company. So you can do that, but you're forced to take the cash. Zim has been good. And what's the other way to get a return on your investment? You sell stock. Ideally at a profit, of course, but that doesn't always happen that way. But there are many ways you get a return on a stock, but the other ways are a little more nuanced. So let's just stick to the obvious: dividends and selling stock. So I'll just show you some of the stuff we did and how you can we call it dividend mining. So you go to any screener. I'm not promoting this website. They do give it to me for free. It's called businessquant.com, but there's screeners for free on Yahoo Finance. So I just started out. I already ran this one, but I put dividend yield. So I pretty much took anything above everything above 1%. And we could filter out the lower dividends, because it's not too sexy getting a 1% dividend. We can filter. Well, I'll show you the filter in a little bit. So I did that. And then I did a dividend coverage ratio, which is just dividend coverage ratio. And I ran that. And I put the dividend coverage ratio in this column. So this is the market cap in billions. Here's a dividend and dividend coverage ratio. Do you guys know how to calculate dividend coverage ratio? I mean, it's good to know how to do it. You don't have to know how to calculate it, but I mean, I'd rather see dividend coverage ratio is how many times net income covers dividend. I'd rather see free cash flow instead of net income. The number of times that a company can pay its dividends. That would be ideal. But I'm pretty sure most websites do the traditional. Is a measures number of times. So this is just a definition: the number of times a company can cover their dividend payments. So, yeah, it's going to be net income they use. So it's net income over dividends paid. So and I urge you to do the math, because if you assume all these websites have accurate data, then you're going to make mistakes, because the data is usually accurate, although sometimes it can be stale. Like, for instance, some companies don't provide data every day. So maybe some of these companies, it's data as of the end of 2024, even 2023. Yeah, I'd rather see cash flow over the difference per share, and we could we could recalculate it. So this is just a start. This is our starting point. This is everything with the dividend. Here's the coverage ratio. NA, what NA should mean is that they have negative net income, so they have no coverage ratio. But I'm gonna show you how to confirm this stuff. Obviously, we're not gonna. So this is everything above a 1% dividend. There's 1,528 stocks. So let's just filter out. I don't know if you're familiar with Excel, but on the top here, I went to data and then filter. So this way I could filter out the data I don't need. So I'm going to go to the dividend one, and you can see we can pick and choose. This is everything with a 1% yield, 1.1, 1.2. I'm going to go to number of filters, and I'm going to go greater than. So let's pick greater than 0.06. Anything above a 6% yield. Okay. So let's see how many there are. Actually, I'm going to do something different because I want it to be visually understand it. Okay, so I'm going to just, this is all the data here in div tab. I'm going to do div 2. And I'm going to sort, I'm just going to sort it by column F. So data, sort, I'll show you why, but so now it's sorted from lowest to highest. So lowest is 1, and I'm going to just delete everything below a 6. So I'm going to keep going down. I'm at 1.7%, 2%. Because you're not going to spend, you could spend your whole life trying to confirm the data for 1,000 tickers. But we don't care about the 1 and 2%. We want to see if a company is offering a high dividend that's stable, that we can count on. Because if a company offers a 30% dividend, that doesn't mean anything. Because nobody pays a 30% dividend. Maybe they'll pay it for 1 quarter, or Zim paid it for 1 year. Okay, so let's get rid of everything at 6.0 or below. So I just wanted to delete everything. I'm going to count. So this is going to be equals count A. I think that's the formula, count A. So this is a visual count of everything. So still a lot of tickers above 6%. So you could probably spend a week going through 279 tickers. Let's just assume the coverage ratio is correct, because I know some tickers it's not correct, but let's just assume it's correct. What we're going to do is we're going to get rid of all the NAs. So let's sort. Let's sort it by column G. So I'm going to select all the data. Data, sort, column G. I'm going to sort it from largest to smallest. So it still got rid of the NAs. Okay, so I'm going to delete all the NAs, because when I see NA, that should mean they have negative net income. And that's why it's NA. I'm going to get rid of all the NAs. Okay. Now we're down to 205 tickers. I'm going to get rid of all the anything below a 1.5 because I want them to cover their dividend at least 1.5 times. Because if they say they can only cover it one time or 0.8 or 1.1, there's not much room for mistakes. Okay, so now we have 38 tickers. Now we have a subset of tickers we can really dig into. What do you think of something like UPS? I don't know. You mean for a dividend payment or as an investment? So this jumps out. This looks really tempting, right? A 7.6% dividend, and they cover it 158 times. So that's something we want to look at. So let's ticker MPLX. So let's just confirm it's correct. So let's go to Yahoo Finance. MPLX. So they're at 7.28%. This is 7.6%, so that's good. It's a timing thing. Every day the yield changes, right? Every day the stock market's open because the dividend yield is based based off of the stock price, right? Okay, so that looks good. Let's go to financials. Let's just make sure net income. So net income 4.29 billion. Let's just put that in here. Let's go back to the screener. Let's now do a search for net income. Net income, common stock, trailing 12 months. Okay. Let's export it. So here's all the net income. Let's make a column for net income. NI. Okay, so I'm just going to do a VLOOKUP. I'm going to search that ticker and go back to the Excel file that has net income. Okay. And this is billions. Net income billions. So look how high the net income is, 4.3 billion. Look at all these other ones. Most of them are below 1. I like MPLX. I have ET. Yeah, I got a K1. I mean, K1 is not a bad thing. It just takes. You can't usually file your taxes on time because you tend to get the K1 late, like April 15th. But it's just one part of your taxes. Your account can get it all set up, your taxes, and that one piece they can just add on when you get to K1. That's how I give it to my accountant. Okay. So we got net income in here. Now, let's see if they give you dividend. Dividend per share. Let's see. Dividend payout ratio. Dividend payout ratio is also good because you can see how many times they pay out their net income. So you can just calculate dividend payment, because if they're giving a 7.6% dividend, you can multiply that by the market cap. Why is so the dividend times the market cap? Let's move this over there. It's getting in the way. So we could tell it's so that's how you calculate the coverage. Huh. Okay, so I think we have everything. Let me get rid of that. That's confusing. Okay. So okay, let's just sort it by the yield. I just wanted to confirm the numbers were correct, at least for the first couple. Okay, so obviously, I mean, it has a negative market cap. Okay, let's just look at QXO, just to confirm what it even is. $5.3 billion market cap. I'm not sure why this website had a negative market cap. Let's fix that. Okay, this is what happened. So if you're curious, because when you see stuff like this, 165% dividend, it's probably a mistake, but it'd be good to know why it is that way. So back in June 2024, they paid a special dividend. This has to be a special dividend because it's $26. And you could see how big the dividend is. And they don't pay a consistent dividend. Before June 2024, they paid one August 2023. Before that was in 2021. You can filter out So I'm curious. QXO special dividend. Okay, here's a report from the company. We currently do not intend to pay dividends on our stock for the foreseeable future. And this article is from July 2024. What is this? Does anybody know what this company does? QXO. This is kind of like, you got to do a little more research, and like, because not everybody's looking at this stock. There's so many stocks, like the top, like 500 stocks, 500 in terms of market cap, everybody's looking at. And like the top 100 stocks, there's like 1,000 analysts looking at each one of those. But some of these stocks nobody's looking at. So it's good to know, to see if there's any hidden opportunity. Buffett used to do that when he used to read through all the rating agency reports. Is QXO? Let's see, what does QXO do? Okay, it's a value-added reseller of business application software. It offers software solutions for accounting, financial reporting, enterprise resource planning. I mean, it's not a small company, 5.3 billion market cap. You can feel, why did they pay this $26 dividend? You think it would be talked about somewhere. Let's see, that was in June 2024. Let's see, QXO dividend, June 2024. QXO has a dividend yield of 203% and paid $26 per share last year. This blurb is like taken from, it's just like a download from another report. Nobody, a human didn't write this, but I want to get a report by like an analyst talking about this. Let's see, Wall Street Zen. Victor, what's up? How's it going? Yeah, I'm trying to do more live streams, different topics. I'm trying to understand why this company paid a $26 dividend. This is another just kind of downloaded information. It's not like I want to report somebody wrote. I have a feeling I'm not going to find it. Yeah, we should do we should try to do it more often, like every other week or something. It's good to you know, get each other subs to watch. It's so this website, they have the $26 dividend. Okay, let's go to the companies. Okay, usually if you type in the ticker, then investor relations, every single publicly traded stock should have a page on the website called Investor Relations. And that's where you find all the SEC filings, any report, the 8K, 10K, the 8Q, the 3, 4, and 5. Like when there's significant things happening, companies have to submit a report. I think it's 5 or maybe it's 3. I can't remember. But so if they acquire another company, if an insider buys a lot of shares, if they change their accounting rules. But so that was in June 2024. So June is a third quarter, but they wouldn't have it in a press release in the third quarter because when they submit this report, it's usually, well, let's look at it. Maybe it is. It's not a matter of the stock price crashing. It might have crashed, but they paid a massive dividend. I'm not saying when a yield goes really high, that's when a stock crashes, but they went from even not too consistent. See dividend of $4, the following year $3.20, the following year $4.80. So it looks like kind of an annual dividend. Then they skipped 2 years. Then they gave $1.60. And then in June 2024, yeah. So in August 2023, $1.60. The next dividend was $26 in June 2024. Yeah, I Googled special dividend, but nothing came up. Okay, including if dividend may have one company common stock. Oh, it might have been on preferred stock. But it shouldn't be the section. This should be common stock dividend, not preferred stock. But it's possible it got, these websites make mistakes. Okay, so I mean, I don't know. I thought it was a special dividend, but I can't find anything on it. So this is a situation you would just kind of ignore it because they pay a dividend almost every year. And this is not something you can really count on. We knew that. We knew it wasn't reliable, but it's just good to know these things. Let's get rid of that one. A steel company. So this is a real company. When you see one of those like finance companies paying these weird dividends, you could probably ignore it because it's okay. Let's just Masabi Trust, 29%. Once again, I wouldn't rely on these, but I just want to know why. Because maybe remember Zim, and they were paying a 50% dividend. If we would have looked into it, we might have been able to identify a company that was paying a dividend that was kind of reliable, and they actually paid it for 2 years. Okay, this is a royalty trust in the mining business. So the goal is we want to identify stocks that pay high dividends and then see if it's possible they're going to be paying that dividend in the future. Another crazy high dividend, $5.95. So this is a trust. So the way it works is the dividend is paid based on how much money the company generates. So if like in this quarter, they were really profitable. So they were able to give out a high dividend. And in this quarter, they gave a 9-cent dividend in July 2021. So it's really based on how profitable the trust is. Now let's see if we get more information. Masabi Trust. So they paid a $5.95 dividend this year in January 2025. Masabi Trust. Let's see if I can put in $5.95. Let's see if the dividend comes up. Here we go. Alberto, yeah, you got it. They mine iron ore pellets for Cleveland Cliffs. Okay, so Masabi Trust gave a dividend of $5.95 per unit. So this is an MLP, I believe. Well, it's not a MLP, it's a royalty trust. But I wonder if they also give K1s. There's Masabi Trust. I don't know. Dow is a good dividend stock at this time. So this compares to a 37-cent dividend per unit in the same period last year. So this is what I was looking on for the other stock. I wanted something like this, like a real report by the company. Okay, so the $5.95 dividend is a substantial increase compared to 37 cents. The dividend reflects the trust non-recurring revenue from net proceeds of the American Arbitration Association Tribunal's final award in favor. So this looks like some type of lawsuit that they won. So when they say it's non-recurring revenue, that means you can't expect to receive this again. It's a one-time thing, because if you have a subscription model for your business, that's recurring revenue. But if you have, say, a new customer who gives you $1 million for 10 years of service, they just pay one. That's non-recurring. You can't expect that every single time. But this is how you kind of learn about this stuff too, by looking into it. That's the proceeds from the American Arbitration Association's tribunal final award in favor of the trust in the amount of $71 million, which North Shore Mining Company and Cleveland Cliffs paid to the trust. So there was some type of, I think it's a lawsuit, and they received cash infusion of $71 million. And this is a trust. It's not like a regular corporation. So they can't just keep the money. Like if Philip Morris won a lawsuit for like $10 billion, they could do whatever they want with that money. They don't have to give it to the shareholders as a dividend. But legally, they have to pass on, I don't know, it's probably like 90% of all cash inflows to the investors as a dividend. Because the people who run the trust, they receive a salary. Like part of the trust may charge like a 3% fee. And that 3% is used to pay the employees, to pay for rent, all the overhead. but that's it. After that 3% is the fee. So if you're working at the company, you're not going to be like, yay, we get $71 million to split between us. No, it goes to the investors. So that payment satisfied the AAA panel's unanimous award of damages, including pre-award interest for underpayment of royalties. So they were suing. They were suing North Shore and Cleveland Cliffs for underpaying. So they received less royalties than they should have from I guess it's sponsor companies. Somebody mentioned Cleveland Cliffs as a sponsor. So this is going back 3 years, 20 through 2022. So if you were a shareholder in 2020 and say you sold in 2022, for instance, you would not get this dividend payment, even though you deserve it because it's for the benefit of the shareholders from 2020 to 2022. But only the shareholders today get the money because you don't retroactively go back. But this is good information because, sure, maybe we wouldn't buy stock now because we're probably not going to get a huge dividend. But what if we read about something like this before the lawsuit was done, right? Say maybe if they were working on a lawsuit and maybe they were expecting to get payment next year, then we could buy the stock today and collect that dividend. It's called Arbitrage. There's a website, Arbitrage stock website. But arbitrage, this is a type of arbitrage, but arbitrage, what I'm talking about is acquisitions. I think I shared it once before. The way the website works is it shows all companies that are going to acquire another company, but the acquisition hasn't been completed yet. So if say company X is going to acquire company Y for $10 a share, right? That means if you own company Y stock, you will get $10 once the acquisition goes through. So if Y was trading at $8 and the acquisition was for 10, you could just buy the stock today and $2 is your arbitrage opportunity. It's a guaranteed return if the acquisition goes through. But the problem is the reason Y is trading at 8 and not 10 is because there's a chance the acquisition doesn't go through. There's no guarantees. So that's a website I was looking for. It shows all companies who plan to acquire another company at the acquisition price. Maybe I wrote it in my phone. No, I don't have it. Maybe the site isn't up anymore. I thought this might be it. I think this might be the site I'm talking about. No, this site, they only list like 3 companies. They want you to pay for the site to see all the companies. So this is pretty much what I'm talking about. Okay, this is the closing value if Highwire acquires the target company, SGRP. So Highwire announced they plan to acquire SGRP for $58.2 million. And that's a deal price of $2.50. So when the acquisition goes through, every holder of SGRP will receive $2.50. But SGRP is trading at $1.14. Sigma Broadband. I wrote it the wrong ticker. Spar Group. See, so this is Spar Group. It's trading at $1.14 currently. Right here, currently. So that's correct. And the acquisition price is $2.50. So that's your return. You get 120% return. The way it works is $2.50, $1.14. So this is the acquisition price. SGRP price. And then that's your gain. So you get 119% return. Is that correct? 120%. It's probably a rounding thing. It probably goes out a few more decimals. So that's your guaranteed return, 119%. If you buy SGRP today and the acquisition goes through. The reason SGRP is trading at $1.14 and not, if it was a slam dunk acquisition, like it was definitely going to go through. Like there's really no barriers. Then SGRP would be trading at $2.48 or $2.47, not $2.50 and not higher, but really close. But since it seems like it's probably like a 50-50 or maybe even less of the acquisition going through, that's why there's such a great arbitrage opportunity. I researched it 1 year ago. I think Masabi's royalties problem was that the royalty ended at a certain point after the death of the founders. I'm not sure what you mean by, but Masabi pays consistent dividend. Is it quarterly dividend or is it annual? They pretty much pay a quarterly dividend based off of how much money the trust generates. And this most recent quarter, they just happened to settle a lawsuit because they were underpaid. Their dividends were underpaid from 2020 to 2022. So they won this lawsuit. And then they passed those all the funds to the shareholders. So it's not going to happen again unless another lawsuit comes up, which could happen, but there's no way to predict that. The trustees have received no specific updates on Cliff's plan for the current year concerning North Shore iron ore operations. Let's see. So quarterly royalty payments from Cliffs and North Shore for iron ore production and shipments during the calendar quarter of 2024 are payable to Masabi Trust. So that's what I was saying before. All payments for iron ore production and shipments are payable to Masabi Trust under the royalty agreement. So whoever is invested in the trust gets that minus whatever, like they charge a 3 or 4% expense ratio. Does anybody know the expense ratio for Masabi? it's not listed anywhere, but it's somewhere. The expense ratio. Expense ratio. I don't know. It's probably hidden somewhere because it's not like a regular ETF or mutual fund. You could see the expense ratio like on the main page of like Yahoo Finance, but it's probably hidden somewhere because it's not it's a royalty trust. Fees are taken from operations. So okay, so it's not a explicit. Of course, there is an expense, a percent that's taken out as an expense, but it's just taken out before, I don't know. But anyway, so this website, this is the Arbitrage website. There's probably another one because I don't want to pay to see, but like Getty Images Holdings, 62%. And we could, this is when they announced the acquisition. So this acquisition was announced in September 2024. So a year and a half. So that's probably why the arbitrage is so wide, because it's been sitting around. The longer it takes, the less likely it is to happen. This was announced in January 2025. So you can read about it. Getty Images and Shutterstock to merge, creating a premier visual content company. So this gives you an idea if there's going to be any antitrust violations. That's really the main way it doesn't go through the acquisition. Okay, so we're wasting a lot of time on these, and we kind of knew that these really high dividends, they're just not reliable. So let's look at one that we think is a Zim. This is a good one. So 22% dividend, they can cover it 3.7 times with their net income. So that should give you a little comfort. Okay, Zim's a good one. So let's a big problem also when a company pays a high dividend is if, say, you buy a stock that actually pays a 10% dividend, but if the stock goes down 10, 15, 10% or more, say it goes down 20%, that wipes out your dividend. So it's good to look at the historical dividends to get a sense. So this is a bit lumpy, right? So March 2025, $3.17. Before that, December 2024. So 3 months before. So it's 4 straight quarters of dividends. So that's good. They did take a break. They slashed their dividend. Look at that yield, 87%. And then they stopped paying a dividend for a few quarters, but they brought it back. And it's been 4 straight quarters. So that should give you a little comfort. And they pay $3.17 per share. Dividends. $3.17 per share. And how much is a share? $14.34. Okay. I'm just confirming the math. I come out with 22.1. This is 22.4. That's fine. Let me get rid of that. It's just annoying me. That's a calculated dividend. Let's see, how many shares do they have? So shares. It's 1434. Well, you take the market cap over share price. This is in billions, so 120 million shares. So they have 120 million shares. They pay $14.34 per share. Okay, I just wanted to confirm I did my math right. 1.7 billion. Okay, so that's good. So we'll look at the free cash flow. The latest free cash flow is December 2024. It was 3.5 billion. So 3.5 billion. Remember, I formatted it to billions. So that, you know, free cash flow is a better measure than net income. So let's just see. We're going to multiply the number of shares by the dividend per share. So how much does it cost them to pay a dividend? It cost them $380 million. Because what we did, we took the number of shares times the dividend per share. So it cost them $380 million dividend cost. Let's see how many times their free cash flow covers the dividend. 9 times. This is 3.7 because they use the net income. Let's look at the net income. The net income is 2.1 billion. Okay, it's right here. Net income 2.1 billion. Okay. So what's net income over the cost per share? I mean, the dividend cost. See, I'm calculating 5.6. I've never liked dividends. To me, it means that the management has poor capital allocation strategies. Well, that's one way to look at it. And that's why Buffett doesn't pay a dividend. Berkshire never paid a dividend because you don't invest. I mean, the idea of investing in a company is so that company, makes a product or provides a service and it's profitable in doing that. Like the reason you invest in Tesla is so they make cars, and they sell the cars for more than they make them for, and make a profit. And that's how you get a return on your investment. Dividend is just giving you money back. So giving some dividends could be good, and some people like that, but I have no problem with a company not paying the dividend. Okay, so we're just going to use free cash flow because we think it's a better measure. This is the free cash flow coverage ratio. So they can cover the dividend 9.2 times with their free cash flow. This is the annual dividend. It's not quarterly. So the free cash flow, we're using free cash flow for the year, and this is the dividend cost for the whole year. Let's just make sure. Okay, so 317 is a dividend they paid for 1 quarter. So let's multiply that by 4. So if they pay 317 every quarter, which is a good dividend, that 317 is really based on their current yield. That's a coverage. What's the net income coverage? So this is how you do it. You have to use some estimates at some point because we don't know what their free cash flow will be in the future. But the analyst, their actual free cash flow is $3.5 billion for 2024. It's $3.5 billion. It's right here. You see, 3.5. So that's 3.5. So if they pay 317 for 4 quarters, it would cost them $12.68 for the year. 12 per share, $12.68. And the cost is $12.68 times 120 million shares outstanding. So it would cost them $1.5 billion to pay a $3.17 dividend for 4 straight quarters. And the free cash flow in the trailing 12 months is $3.5 billion. So they could afford this dividend, the $3.17. And what's the stock price now? So the yield is going up because look, stock price is 14. It was nearly double 6 months ago. So it was cut in half, the stock price. And then so they pay 317 this quarter. Last quarter, it was even higher, 365. So The yield is 48% according to, which we know is not right. They have 22%. This is why you should always double check the numbers to see how they came up with it. So they do show you their future dividend payment. So they project their yield for 2025 to be 3.9%, 2026, 0. And this is why they project 0. So we know the current free cash flow is 3.5 billion. The projected free cash flow is 1 billion. That's for 2025. And then after that, it's 190 million. So let's just use 2025's number, 1 billion. If they generate 1 billion of free cash flow, we have to change this number. So we have 3.5. Let's change to 1. That means they can only cover 70% of the dividend payment. So they can't even cover it once. So we have to lower the dividend because they'll probably pay out like 90% in dividends. So right now it's 12.68. Let's lower it to, so 8. If it's 8, they can cover it once. But they're not going to pay 100% of their dividend. Okay, this lowers it. They have to cover at least, I would say 1.2. So 7. So this is what you, if they do generate 1 billion of free cash flow, that's the analyst projection. See, there's 2 analysts projecting 1 billion. You can expect to receive $7 for the year, or $1.75 per quarter. So $1.75 times 4 quarters. So $7. And what are they trading at? $14. So it's a 49% dividend yield. So that means you have to buy Zim because you're getting a 49% return. Of course, if they generate no free cash flow, then the dividend's cut. But what's the big problem? Like how could a company offer a 49% dividend? And this is assuming things go as projected. I'm not even assuming an unlikely scenario. This is just if things just go as planned. Because the company's going to say, we're going to have record-breaking revenue, and they always say positive things. But this is the analyst projection, so it's more of a base case. It's going to go down the stock price. So that's what happened when it was 27. People bought the stock thinking they're getting like a 40% dividend. But the stock went down 50%, right? From 26 to 13. So let's say you pay $26 a share, right? And let's just pretend you really got a 50% dividend. Say for the year. You started the year at 26. You got a 50% dividend. So you made $13 in dividends from this stock. But what if this it gets cut in half? Like, this is exactly what happened. It got cut in half from 26 to 13. This is on January 1st, 2025. If you pay $26, you got a 50% dividend. So you got $13 in actual cash from the company. At the end of the year, the stock is worth 13. So how did you do? How'd you do for your investment? You broke even, right? You didn't get anything. I mean, you have a stock that you don't have to sell the stock. You can keep it. That got cut in half. But you have an asset that's worth $13 and you receive $13 dividends. So that's what I'm trying to convey. Like, just because a company is offering this massive dividend, if the stock price goes down dramatically, like it did in Zim, which probably will go down a lot, you didn't really gain anything. But we can't predict the future. What if you bought it, like they did actually pay? Look, they paid a $2 dividend, that first dividend, then $2.50, then they paid $17, then $2.85, $4.75, and people were making money hand over fist. The yield 60%, and then it got higher to 87%. Can lightning strike again? I don't know. But if it was so easy to make 22% dividend, everybody be piling into the stock. There's a great risk. So that's what I'm saying. If you want to try to find something a little more conservative that might happen, what company is this? So here's a good okay. Here's a 12% dividend, and they cover the dividend 5 times with their net income. So this is like, if you actually want to get a dividend and not be left high and dry like Zim, ABR is the way to go. It's down 12% the past year. So it's the same scenario as that. Like, if you got a 12% dividend and the stock goes down 12%, you don't really gain anything on your investment. But if you don't sell a stock, you might be okay. Let's see where it's been trading. So this should give you a little more comfort. They've been trading 21 years, since April 2004. Imagine getting it for 80 cents. It was 58 cents at the low. So it's pretty much been trading sideways since 2019. So there's definitely going to be ups and downs with this stock. But anytime you see a dividend north of like 7%, it's not going to be it's not going to be like an AT&T. There's going to be a lot of volatility. If you don't want the volatility, just put your money in the money market funds. But this is as safe as you can get with a double-digit dividend. You can see the company consistently pays a dividend, and they raise it every year. So it's 43 cents. That's right. It looks like the current trade war will not be helping Zim. So this could be a really good investment because let's say you how much is one share of Arbor? 11.29. And how much are they paying in dividends? So they're currently paying 43 cents. That was the latest. So 0.43 times 4. So one shareholder gets $1.72 for the entire year. And let's calculate the dividend yield. It's even higher. How could it be higher? Does anybody know why I'm 15% and they're 12.4%? And there's a few things, but I get a 43. I think it just might be a mistake in Yahoo Finance. Do you check Canadian dividend companies like yeah, I definitely okay. See, here's Yahoo Finance, 15.2%, which is exactly what I calculate, 15.2%. I just think this the screener on this website, it's probably like not every stock is updated every day. So this might be like their dividend yield as of like 3/31 or something. So that's why. So the yield today is 15.2%, and nothing's guaranteed. But I think you could pretty much say you're going to get paid on this stock. They've probably been paying for like decades, so you're going to get paid. Zim, we don't really know, but I would say like 95% chance you're going to get your dividend with the stock. Now the question is, will the stock go down 15%? That's the big problem. And you could see it was 16, now it's 11. It did get, yeah. It went from 16 to 11. That was the high. That's the low in the past 6 months. Well, that was the peak. So it went down 9% from the peak 6 months ago in November to today. So you're still at least getting a return. You would made 6%. But now, what if you get it at 11, it goes up to 16? Then you're killing it because then you made 9% on the stock, plus you're getting the 15% dividend. But that's why it's kind of baked into the price. Why does it pay a 15% dividend? Because the stock price is low. The dividend is $1.72. it should be paying. It was 17%, but it was like 9%. So it looks like 8% is where the sweet spot, which is pretty good dividend. 8%. So the share price. So this is the share price today, but it's 15.2%. How do we get it to 8%? Well, it has to go up, the stock price, right? So that's what investors are projecting, the stock price to go to 20 if they keep that dividend. So this is a really good opportunity. You can get the stock now. You get a 15% yield because your cost base is 11.29, and the stock is priced to go to 20, assuming it gets back to the mean where it's been pretty much the past decade. So you'd be killing it with the stock, because once it goes to 20, then they're gonna keep that dividend $1.72 because the yield is 8.6%. But you still have the 11.29 cost basis. It's 31% DRIP, dividend reinvestment plan. Arbitrage could fall big. There are mortgage servicers. Right. You're not going to find. That's what I said. If you want a guaranteed return, put your money in the money market, and don't listen to these videos, because I'm talking about stocks, not guaranteed returns. But if you're looking for a 15% return, it's impossible. There's risk. So I'm just trying to lay out the likely scenario to happen. And this is compared to Zim, this is a safe investment compared to Zim. It's not safe, but compared to Zim, it's very safe. Zim is not safe at all. It's very volatile, very risky. This company, but why is it? But why do people? Why is it priced in to go to 20? Why is the yield so high? Because it's mortgages. There's a lot of risk. People are, especially commercial shopping centers, there's huge risk that there's going to be lots of defaults. They're already having trouble at a lot of shopping centers. Lots of stores just don't get the income they're used to getting, and they can't pay the mortgage. And then the owner of the shopping center can't pay the bank. But yeah, this is kind of like the process. So what do they do? Arbor, we know it's a REIT, but what type of properties are in their portfolio? Because there's going to be a risk. Like anytime you see a dividend 15%, it's not going to be a walk in the park. I want to see their portfolio, what. Okay. I don't think it's going to be on this. This is just about the principles of the company, the people work there. Annual report. I want to see the quarterly, the PowerPoint presentation slides. Arbor Realty declares preferred dividends. There's another nuance to it. If they have preferred shareholders, that's higher in a capital structure. They get paid before common shareholders before you. So that also has to get priced into the scenario. Let's see if we get more information from Wikipedia. Invest in a diversified portfolio of structured finance asset in multifamily, single-family rentals, and commercial real estate markets. So I'd like to know what percent in each, because if they're really heavy in commercial real estate, I think it's a little more riskier. Here's a YouTube video. So they have single family rental investment trends. They don't make it easy to find this stuff. I would have thought it. Okay. Investor materials. Okay, maybe it should be in the annual report. Everything's in the annual report. So structured business portfolio overview. So they're 81% multifamily, 18% single family rental. So it's pretty much residential. It's not commercial. Texas is their biggest. So that makes me feel a little better because a lot of the loans are backed by Fannie and Freddie. So there's kind of like a backstop for losses. But I would just kind of like go through this. You can look at losses they paid out, reserves, because you look at that loss history in the past few years, and it's probably going to be within that range. I mean, but there could be, I guess, people are pricing in like a recession, and that could occur. I don't know about long term. I was just trying to. How is 16 minus $11.45? It was a typo. Good catch. I did 16 over 11. So that's even more egregious. 31%. Good catch. That's how much the stock fell, 31%. That makes a lot more sense. Because I was wondering why it fell so little. Because I would think to get a yield that high, you need a much more volatile stock. Okay. I'm glad someone caught that. I'm just kind of showing the process, like how you would look at a dividend. It's not super straightforward, but I'm getting a little deep into the weeds. But simply put, you look at the dividend yield, you look at the coverage ratio, and that gives you an idea if they can cover their current dividend. Like in Zim's case, it gives you the comfort, but you need to do a little more due diligence, because if you'll see that the company has not been that consistent. They, 4 straight quarters of dividends. They took 2 years off before that, and then before that, it was all over the place. Yeah, anytime, like these are abnormally high dividends, so anytime it's that high, there's going to be a lot of risk involved. But we want a high dividend that's not too risky. And there's definitely be some risk, but if you look into these a little deeper, you'll probably be able to find a really good investment. I'd say, like, on a risk measure, this is like a 90% chance of it not going the way you want it to go. Zim. Only a 10% chance of them paying the dividend they've been putting up. But this also kind of gives you an idea of how to dig in. So MPLX, that looks a little weird. 158 times they can cover their dividend payment. I think that's a mistake, or 4% is a good starting point. Yeah, I think 4% is definitely good. If you're looking for a somewhat guaranteed dividend, 3 to 5%, like a high, somewhat guaranteed, that's probably in the range. But you definitely want to dig a little deeper. Sometimes those aren't guaranteed either. But for these, there's a risk. But you might hit it out of the ballpark. Like I said, if you were to buy Arbor and you're currently at a 15% yield, if the stock price does go up as expected, because they're not cutting their dividend. We saw that. They haven't cut their dividend the past decade. So there's only one way for the yield to go down to a normal level, to like 8% or 7%, is that stock price goes up. But let me know if there's another one of these stocks. I don't know why it says coverage 158 times, because I calculate coverage of 1 time. The way you calculate how much money they pay in dividends is the dividend times the market cap. So they pay out $4 billion of dividends. But you should always double check numbers, because you learn how to do this stuff. And also, like I make mistakes all the time, but then, like I did earlier, and then when I'm trying to go through the numbers and correct it, I learn a lot as I'm doing it. So the annual dividend is $3 3.383. That's the annual dividend for MPLX. And how many shares? The share price is 52.56. So how many shares? It's 53.6 billion over 52.56. So 1 million shares. So if they have 1 million shares and they pay 383 per share, that's how much it cost them to pay dividends to their shareholders. 3.9 billion. So I was at 4 billion. There's just another way to do it. So about 4 billion. That's how much money they spend for the whole year in dividends. I'm just trying to confirm why the numbers. I think it's just a mistake. They're 4.3 billion is their net income, which is right here, 4.3 billion. So they can only cover it one time, not 158 times. But I can't figure out why it's 158. Usually it's like a funky thing going on. Let's look at the free cash flow is 4.9 billion. So it's even higher. Free cash flow 4900 123 123. So it's 1.3. So they can cover their dividend 1.3 times with their free cash flow. So it's not going to be 158. This is just, I don't know how it got there. That's what I wanted to do. Check that. So they did pay a high dividend in 2021. I'm not sure why it got so high. Something might have happened. It could have been like a lawsuit or something. They got a big cash injection. So they pretty much raised their dividend consistently. So it's another pretty safe one to put money into. Okay. I hope it was a good exercise. I'm kind of just thinking as I do it. I'll try to put it together in like a video format, so it's more streamlined and easy to follow. Because I don't do this every day, but I've done it before and I know how to do it. But just finding all the numbers and then doing the calculation, it could be a little confusing because I'm not going in like a set order. But another way to get a quasi-safe dividend is look for a high market cap company. If a company is 100 billion market cap, it's much more likely they're going to pay their dividend than a company with 1 billion market cap. So I want to put together like a checklist, dividend safety checklist, and like if the market cap is over 100 billion, then they get the top score for dividend safety. If it's under 1 billion, then they get a low score for dividend safety. And then you just kind of check the boxes. How safe is the dividend? The most important thing in safety is free cash flow over dividend payment. How many times they can cover their dividend with their free cash flow? That's the most important thing. But other things are also important. How big the company is. Do they consistently pay a dividend? Have they missed any dividends? Do they raise their dividend each year? If it's like Zim, it's just up and down, up and down. There's no order. the safetiness factor falls a little bit. I've seen the dividend coverage ratio expressed as a percentage. Well, I could do it. Yeah, like I'll show you as 165% or 1.7. Yeah, it is a percentage, right? On websites. I was thinking of it as a in my head, I was thinking of it in a number of times, but it doesn't matter how you do it. This website does the way I do it. DCR, dividend coverage ratio, 13.2, 17.5. But it doesn't matter how you do it. It's all the same thing. Are you thinking dividend payout ratio? Because that's different than dividend coverage ratio. Maybe you're thinking dividend payout ratio. But like I said, it doesn't really matter. No analyzed developed a methodology for creating a dividend portfolio called UNH. Seems like a good deal. United Healthcare. It's a big company. So this is like another guaranteed dividend payment. You can see they raise it every year, and they don't miss a dividend payment. It's $2.10. The quarterly dividend, the annual dividend. So we take the current quarter times 4. Market cap 381.1 billion. The shares outstanding. Okay, share is for 1864. I guess that's shares outstanding 910 million. Annual dividend cost. This is how much it costs them to pay the dividends for the entire year. So shares outstanding times the annual dividend. Let's convert that to billion so you could see it. So they can cover their dividend 7.6 times. They cover, so that's a pretty good coverage, right? They cover 7.6 times. But you can see the stock went down 15%. So if you bought the stock a year ago and you received 2%. Okay, it's a 2% dividend. I was wondering why it's so low. I thought it was higher. Okay. So if you bought the stock a year ago and you received 2% in dividends, you're doing awful, because like if you bought it exactly a year ago, you're down 15%. So stock went down 15.5%. So your return for this investment is you lost 13.5% by investing in the stock. That's if you sold it. But that's how you have to look at it. Even if you didn't sell it, you have an asset that went down 15%. Yeah, it was 600 in April, and we know why it went down so much. It's a good time to pick it up. So yeah, I'll work on the dividend. I'll work on the spreadsheet and try to put something together a little more polished. I think I have a dividend model, right? Oh, the dividend discount model. This is just so you can calculate. You can do a discount, not a discounted cat. You can forecast a stock price based on the dividend. It's called a dividend discount model, or the Gordon growth model. You just have to enter everything in black, I guess. So this is ticker T, AT&T, the stock price 23.18. This is a few months ago, but how much they pay in dividends, the WACC, and the growth rate. And then based off of how much they pay in dividends, you calculate the stock price and compare it to the actual stock price. The problem with this is it's assuming the company pays 100% as dividends, because as we know, the stock, you get a return on your investment if they don't pay a dividend, or if they pay a partial dividend. Because the stock price goes up a lot, you make money on the stock, or at least you have a return. Your return's positive. But if the stock price goes down, you'll lose money. You lost on that investment unless the dividend covers the loss. But you should really combine them when you do. But you can email me. I think I sent this out. This is one of the models I sent out. That's a growth rate of the dividend. You can just, I mean, it's really guesswork, but you can look at the last dividend, compare the last dividend payment to the current dividend payment, and then calculate how much that grew and put that as your growth rate. Or you can just pick a flat one. Yeah, I mean, it's just there's more than one way to skin a cat. But yeah, maybe we'll do this again, this exercise, and I get it more kind of polished. But like when you see like those YouTube channels, what's that channel? Those guys who have the check mark, did free cash flow go up from last year? Check. Shares outstanding, did they go down? Check. And you do this check mark, and then it gives you an idea of if it's a good value. That is good to have kind of that structured routine, but it's never like structured and easy to follow. It's real nuanced, and it's not going to be straightforward. But I'll try to make it 9.1% current yield. So that's pretty much flat in the past year, up 3.5% in the past week. So this is if you did get a high dividend, you actually got a high dividend with this stock because the stock didn't really move much. It actually went up 1.5%, so you gained a little. 9% dividend. So how could it be so high? Well, obviously the stock price came down pretty quickly at some point. Yeah, so it went from like 24, so not that much. So why don't more people buy the stock? Here it is. This is what happens. There was another. Is this like a mortgage REIT? Negative buyback. So they pay you a 9% dividend, but they're issuing 9.5% of their shares. So they dilute you 9.5%. Another nuance we could throw into the equation. This is a good too. Yeah, I'll redo the dividend video, and we have to add buybacks too. I mean, there's a million things you add. It's never ending, and it's so confusing. The more things I add, then you have to add stock buybacks, and you have to add this. Oh, it's a BDC. Okay, business development company. So they invest in medium, small size business. But it's pretty consistent. And the way you consistently pay a 9% dividend is you dilute your shareholders by the same amount. Because what happens when they dilute shareholders? Then they get the money. Because when you sell shares, you get cash, and then you take that cash and give it as a dividend. But it's kind of working because they fool people like you thinking you're getting a good deal. And the stock is pretty steady. It did come down here, and during COVID it came down, but it's pretty steady. I wonder what the market cap is historically. I think Yahoo Finance has it shows you the market cap the past few quarters. Okay. So the market cap keeps going up because it looks like they're adding shares, right? And the stock price is not coming down. And because they're paying such a high dividend, people are willing to buy the stock at the higher price. So it's kind of like, what's that? Really low PE. It sounds like a Ponzi scheme in a way. They really trick you guys. Oh, the BDC, that's right, helping businesses help create long-term. So they invest in smaller private companies. And so at least 70% of its assets have to be in private or public companies with less than 250 million market cap. So they do invest in publicly traded companies, but also private companies. And they have to give at least 90% of its profit to its investors. And it's similar to like a REIT. They don't pay corporate income tax since they it's like a pass through. Yeah, so the buyback thing cancels out the dividend. But the market cap keeps going up. If the stock price is steady, you would think the market cap will be steady, but no, they're just adding more shares. So that raises the market cap. But at least the market cap is not going down, which happens also in cases like this. There was a mortgage REIT. It was paying like almost 100% dividend. I can't remember the name of it. Does anyone know that mortgage REIT? It was a weird stock. Public mortgage REITs. Arbor was on that list. It had a really low market cap too. I think it had a low market cap. Invesco, right? Didn't it have like a because they do all these weird things where they add shares instead of buybacks. Yeah, I think Invesco is what I was thinking about. Here's Aries right here. Okay, I hope you learned something new. I'm just testing out these types of things, but it's hard to kind of explain it as I'm doing it. But I think a lot of people really learn some new techniques. And yeah, we got work tomorrow. I know it's terrible, but back to reality. Okay. Well, thanks for watching. I'll maybe during the week I'll live stream. Okay, talk to you later.